Absolutely. Thank you so much for the time on today's schedule. I really appreciate that. And thank you for the introduction. WealthCare has been a phenomenal product that we feel really fits multiple needs of retirees and pre-retirees, coming into retirement, looking to plan not only for income for themselves with multiple other products, but wanting to plan for a legacy for their loved ones. And that's where we see WealthCare being a really phenomenal fit. It's a single premium IUL product. It allows for efficient wealth transfer or legacy creation while giving the client or while allowing the client to maintain control, because it has 100% return of premium and flexibility with built-in chronic illness rider. So today we're going to take a few minutes to review the product itself, just a couple high-level features, and then we're going to talk a few minutes about sales ideas and where we're seeing success with this particular product. WealthCare single premium IUL, great for repositioning wealth for your clients while giving them control and accessibility of it. How we do that is through a number of features. One of those features is the 100% return of premium day one. So think of this as a repositioning of assets versus a premium payment. So for instance, you have a client who has some assets on the sidelines, CD money market account, for instance, they want to reposition that. We can move $100,000 from a CD or money market into WealthCare. They still have access to it because it has 100% return of premium from day one for them. We find that a lot of clients like that feature. There's a guaranteed death benefit with this product, a lifetime guarantee. So it is an IUL chassis, but we do provide that guaranteed death benefit, again, because we are looking more for those legacy-minded clients, and that guarantee is important to them. So the other perk of it being an IUL is that there's upside potential with downside protection. There's a guaranteed bonus of 0.5% that starts in year 11, and it is guaranteed. So there's no fiery hoops with this IUL. There's no gray space. Everything is very clear. It's a very easy to explain and understand product. And again, that guaranteed bonus starts in year 11. And one of the most important features I think this product has to it is the chronic illness rider that's automatically included. Goes up to $500,000, and there's no additional underwriting for this feature. There's no senior supplement. There's no phone interview ever. So it's really important to know that that's automatically included on the preferred risk class. And the preferred risk class goes all the way down to table 4 for us. So it's not your traditional preferred category. And it's eligible for our accelerating program. To Larry's point earlier in the introduction, that's going to be your streamlined underwriting experience. So no phone interviews, no senior supplements, very limited APSs, limited labs and parameds, and really a lot of electronic and behind the scenes underwriting such as MVR, MIB, prescription database history check, LexisNexis. We're really technologically driven as a company as far as our underwriting goes to really create that streamlined experience for both you and your advisor. And it offers very competitive commissions on this product. So you can reach out to Larry and Greg and the team to talk a bit more about that. I do want to spend a few minutes talking about the chronic illness rider because I do think it's one of the most important features of this product. Again, it's automatically included on the preferred risk classes that go all the way down to table 4. Easy access to funds when needed. So the way this benefit is triggered is the client can't complete 2 of 6 activities of daily living, or they're diagnosed with a cognitive impairment. It's one of the shortest claim forms in the industry. It's literally 1 page front and back. The client checks off which 2 of ADLs they can't complete on the front. Their physician checks off which 2 of ADLs they can't complete on the back. They submit it to us and we process the claim. It's an indemnity-based benefit, which means no receipts are ever needed, and there's no recertification for this product. So it's once and done. They don't have to go through this claim form every 12 months. There's no upfront charges for this rider, which means if the client never needs it, they never pay for it, which has been something that's been very well received with the clients. If they do use it, there's a one-time $250 fee when they turn on the rider. That comes out of the first month's payment to them. The way it works is very plain and simple. There are no factors. There's no gray space when explaining this like some other carriers have. If you have, for instance, a $500,000 death benefit, $25,000 remains in the policy for the client's beneficiaries. That doesn't come back to Sagicor. It stays there for their beneficiaries. Then the remaining death benefit that's left is divided equally over 48 months to the client. The $250 fee is taken out of the first month's payment, and the rest are equal monthly payments for the 47-month period. If the client should pass away, say 3 or 4 months into the claim period, it's a simple dollar for dollar equation. Whatever was paid out to the client gets subtracted, the rest gets paid out to the beneficiary. So it's very easy to understand and very easy to explain. So with that, we'll talk about a few case studies and a few sales ideas where I'm really seeing this particular product win and knock the cover off the ball. One of the most popular positionings I see of this product is repositioning of CD or money market assets. So with COVID, I'm sure you guys know, multiple, trillions and trillions of dollars have moved onto the sidelines this past year. So this is a really hot topic for us, is repositioning of those assets that aren't earning any money sitting in the bank. So this was a particular case I worked on a few months ago. A husband and a wife, age 64, the wife was age 60. They had $100,000 in the money market account. Financially comfortable couple. The husband had had a pension. The wife had a 401k. They had adequate income for their upcoming retirement. They were not concerned about, themselves or generating income during their lifetime. The wife's mother was currently going through dementia, and the wife has been the caretaker and kind of the coordinator of all of the mom's care for the last several months. So she's kind of had a firsthand experience with chronic illness. She kind of knows firsthand all of the time and effort and finances that go into that. So that was, top of mind for her. Some of their goals was they wanted to leave some money to their grandchildren. They had 2 grandchildren currently, thinking they're going to have more in the future if they didn't need it during their lifetime. The concerns they had were they didn't want to risk the money, but would love the opportunity to grow the funds. And they really didn't want to give up control of the asset. They had kind of in the back of their mind the what if. So we talked about the pros and cons of potentially leaving the funds in the money market. The cons, minimal growth, they're paying annual taxes on that. Probate if it's not set up correctly. The pros to this is there's no risk to the funds, which was something that was important to them, and they have access to them if they need it, especially with the mom going through dementia. The wife wanted the money available. Heaven forbid she should need it, seeing what her mom just went through. So we talked about what if we repositioned this to WealthCare? So kind of do what they're doing already, but kind of amp up the game with WealthCare. So the pros to that, in this particular situation, we were able to leverage her $100,000 from the money market into a $211,000 guaranteed death benefit. She was able to retain control because she has 100% return of premium. There's the potential for upside, which she said she would love if she could grow the funds, but it has that downside protection, so we're protecting her from losing any money. The chronic illness rider was automatically included for her, and we took away the tax bill that she has currently and the tax bill for the potential beneficiaries. The cons, if you want to look at it as a con, but just to, be completely transparent, since it's a life insurance product, she did have to go through some health underwriting. So she had to fill out the application, answer some medical history questions, and provide some details on her medications. So obviously different than, say, applying for opening a money market account or an annuity. What we were able to provide for her was increased funds for the grandkids. So we took that $100,000 and made it $211,000 day one. Access to funds if she needs it. She was able to retain access to her $100,000 through the 100% return of premium feature. And we were able to increase those funds for her chronic illness costs should she ever need it in the future. So instead of having $100,000 earmarked in the money market, she now has $211,000 at least earmarked for chronic illness costs. And she maintains control because she can choose up to 4 different index strategies to participate in.
Hey, Jessica, this is Larry here. If you don't mind, I just want to interject.
Sure.
I remember some years ago, some of the other, I'll just say, hybrid life insurance products that were out there offered immediate 100% return of premium. And I think we all know that those things are pretty much gone or they come with a charge. And they do require, in many cases, a telephone interview and a little bit more extensive underwriting. And then many of us have had the experience where we weren't able to get this. So when you talk about the time and the risk of capital being virtually nothing when you can return that premium straight away, I like to look at opportunity costs. Folks on the phone here, money market rates at 0.1, 0.2, whatever, maybe your TD at 0.5%. You're talking about giving up 0.5% on $100,000 or $500 a year to have double the death benefit and access to that much in chronic care. This thing is a no-brainer. So I just wanted to add that into the conversation when we're considering who our potential candidates might be. So thanks, Jess, for letting me join in here.
Oh, please, anytime, anytime. That's a fantastic point, and I think it's a very valid point. So anytime you want to jump in, feel free to.
Sure will.
Perfect. So, and also, as life insurance does, takes away the taxes for the beneficiaries. The other opportunity I'm seeing for this particular product is 1035s. So this product does go down as low as $5,000 for the minimum premium. So it opens up a lot of conversations for many different clients, not just high net worth individuals, but clients that, maybe have $5,000, $10,000, $20,000 sitting in a cash value life insurance policy that needs to be repositioned into something. And this was a recent case that we worked on as well. A gentleman, he was age 65, going into retirement, had $25,000 approximately in a variable life policy. He, as preparing for retirement, he did not want to have ongoing premiums. So that was one thing he was trying to streamline, get rid of those ongoing premiums. He had received notice that the policy was requiring additional higher premiums to keep the same death benefit, or he would have to decrease the current death benefit he had to kind of maintain that premium schedule that he was on. He no longer needed the high death benefit that he had in this policy. His kids had grown, they were financially stable on their own. It really wasn't the same purpose that he had purchased the policy for originally. He did still want to leave some benefit to the kids, so he didn't just want to completely get rid of life insurance altogether. But at the time, he really didn't see any other opportunities to maintain coverage. He also wanted a guaranteed death benefit when we started talking about things. He was really frustrated with the idea of, this particular policy he had currently wasn't guaranteed. So he said if he did anything again, it had to be guaranteed. So we talked about leaving the funds in the current policy and what would happen. Cons, premiums definitely continue. The death benefit is set to decrease or the premiums increase. Either one he wasn't happy about. He could let it ride and let it go, and the cash value would eventually be completely depleted and the policy would just lapse. The only pro that we saw potentially, and this was kind of reaching, was that there was a larger death benefit that he could kind of let ride until all the values depleted from the policy. He was really unhappy with that, wanted to do something with that $25,000 before it was completely gone. So we talked about 1035ing it into WealthCare. So we were able to leverage his $25,000 1035 into $44,000 of guaranteed death benefit for the kid. That kind of appeased him with leaving something for the children. He had no future premiums, which was very important to him as he was getting ready to retire. Still had access to the funds. So he could still get that 100% return of premium for that $25,000, which was great. And he now had some chronic illness coverage, which he did not have on the previous policy. So albeit $44,000 is not enough for chronic care, I'm sure everyone on the phone can attest to that, but it's a great layer of protection and perhaps another opportunity for you to speak to him about other products that might have been available. And con, again, I'm kind of reaching here, but he did have to go through some medical underwriting. So we filled out the application, had to answer the medical questions, talk about his history, his medications, and we were able to get him approved at preferred. And the last sales opportunity that I like to bring up is something that we don't see as frequently as the other two, but something that we do see kind of as an out-of-the-box opportunity and sometimes larger opportunities when this comes our way. I call it the legacy or the windfall legacy carve-out. And this is going to be when you think of clients that are perhaps business owners that are selling a business as they go into retirement. Maybe they're downsizing their home, or perhaps they've come into an inheritance of their own. And when they have that large sum of money they've come into, looking at carving out a small piece of that for their legacy plan. And that's what we did with this particular couple, 55-year-old wife, 56-year-old husband. The wife inherited $600,000 from her mom when she passed away. So we looked to carve out $200,000 of that to check off the box for her legacy plan for her kids. So she had just been through, unfortunately or fortunately, I mean, she inherited $600,000. She had to go through probate with her mom's estate. It took about 18 months to get through probate. It was a bit of a tedious process. She was the executrix of the will and had to handle all of the estate settlement. So kind of the pain point for her was she didn't want her kids to have to go through that, or she wanted to minimize that experience for her children. So she was very open to talking about life insurance in general. So we talked about her goals, and they were to maximize the funds for wealth transfer to her kids. She wanted to leave as much as possible for the kids, but she wanted to maintain access for if her plans change. If an emergency comes up, she wanted to be able to get to that money if she needed to. And she wanted options for growth. Her concerns, she wanted to avoid risk to the principal, and she wanted to avoid probate and taxes upon her passing, since she had just been through that with her mom. So we talked about WealthCare. We wrote it on the wife, not the husband. We were able to get a bit more leverage on her. We were able to leverage that $200,000 into $485,000 of guaranteed death benefit for her. She maintained access with 100% return of premium. She was able to choose from 4 different index strategies. She had the upside potential and downside protection. And she had that increased pool of money for chronic illness care should she need it in her lifetime. So instead of $200,000, she had $485,000 in a chronic illness pool of money should she need her care. So it was a really just a home run for her. She was very happy with this product. So when you think about WealthCare, our single premium IUL, I would love for you to think about it as an efficient wealth transfer vehicle to create a legacy while your clients can still maintain control of their asset and maintain flexibility with that chronic illness rider. It gives them a lot of choices and checks a lot of boxes for the needs of a pre-retiree or a retiree. So with that, I would love to turn it back over to Larry and see if there's any questions or time for questions. And just thank you for the time.